All right, it is Wednesday, meaning that we're in for part two lecture. This is kind of the last day of that we're going to have kind of the formalized lectures structure that we've had the past few weeks. The way it's been in the past few weeks is we've talked about a topic to start on Monday, we've wrapped up on Wednesday, and then we've had a discussion, and then we do homework on Friday. It's going to be a little bit different moving forward as we're going to kind of pick up the pace on things. So we're going to be doing a lot more direct lectures about new materials on Wednesdays. So if you really enjoyed the discussions, I'm sorry they're disappearing after today, but it's just one of those things you got to get used to. Change is always going to happen. Change is always going to happen. So let's go ahead and review some of the things that we talked about on Monday. And remember that we're talking about controls. We're talking about internal controls, which we know controls are just a response to a risk. That's again reflection from back on 367, and I think that's a good start. But now we're in auditing, and auditors have responsibility for controls, okay? So let's go ahead and make sure that we can reflect upon what we learned last time, and then we have that ingrained. So remember, the very first starting point is identification of a risk in an organization. As auditors, we have a specific way that we characterize risk. What is that term called? Give you a hint. There's 7 or 8 of them, depending on how you count. Management assertions. Yeah, management assertions. That's how we characterize risks. Okay, we categorize them according to assertions, which is going to be what is relevant according to how we look at the risk. So risk is designed, or risk is identified. What is created in response to risk? Those are controls. Okay, and those are controls. And then once we know what the controls are, we as auditors we have responsibility for understanding and testing controls. Now, that's a control sequence. I'm not going to put the diagram up, but again, that's really important to understand. Risk related to management assertion, followed by the control, followed by the test of controls. Now, our responsibility with controls varies. We talked about a couple different approaches. We talked about a substantive strategy, and we talked about a reliance strategy. Substantive strategy says we're not testing controls. Reliance strategy says we are testing controls because we want to get at least some assurance from them, okay? Now, I want to be very, very clear on something. When I say testing controls, that's going to be our default. That's not always going to be our scenario, but we're always going to assume that we're testing controls in a situation. Is that true? No. Okay, we're not always going to test controls, particularly in certain situations. We talked about different circumstances where we might not want to test controls, particularly if we think testing controls would be inefficient to do, or we think that we're not going to get enough assurance, or we're testing the wrong assertion. There were a lot of reasons we talked about it. That being said, obtaining an understanding of controls, how optional is that? It is not optional. We always have to have an understanding of a client's internal controls, okay? That's 100% true in every single scenario. If we don't have an understanding, we can't make the judgment of whether or not we want to rely on controls. So understanding is 100% required in every single scenario. All right, let's go ahead and let's talk a little bit of wrap up of some concept with respect to control risk. And then we're going to talk a little bit about how we approach testing controls in a traditional audit. So assessing control risk is the process of evaluating the entity's effectiveness in entity's internal control in preventing or detecting or correcting material misstatements of the financial statements. This is not something new. This is something we have alluded to in previous courses. But remember, there's basically a separation between the types of controls. Usually controls are going to be of the nature of preventing a misstatement, or if a misstatement occurs, they will detect it and subsequently correct it. That's the goal. Technically speaking, we can categorize controls in 3 different areas. We could say that they're preventative, detective, or corrective, but usually detective and corrective controls are paired together. They usually work together. Now, if the auditor plans to follow a reliance strategy, this is usually going to be a situation where they want to set control risk below high. Now, we know control risk, we would like to make that as low as possible. The lower control risk is, the lower risk of material misstatement is. Now, let's just go back to chapter 4 and make sure we can reflect upon that. We understand why I mean that. So we know audit risk is always low. In most of our scenarios, inherent risk is going to be high because we're talking about publicly traded companies that have large operations and a lot of different expanded areas. So a lot of different diverse risks. Very rare that we're going to see inherent risk below high. Is it possible? Certainly. We can have inherent risk be lower, particularly if it's a smaller company, but for the most part, inherent risk is high, which means that control risk is going to be our predictor of what risk of material misstatement is. So if we would like risk of material misstatement to be lower, then we want to make sure control risk is lower. Okay, we would like to make sure. Now, again, that's outside of our control. We can't do more testing and make control risk lower. We're just saying that if we want to make control risk below high, if we want to set it below high, we have to do testing because we have to understand if the controls are working or not. If we don't test the controls, we have no choice. The default is setting it at high because we don't know enough about controls to be able to make any other assessment. Okay. So in order to be able to set control risk below high, the auditor must do the following. So identify specific controls to be relied upon. This is, again, reliance strategy. We want to know which controls are we going to rely on to gain our assurance. We're going to perform tests of the identified controls. And then most importantly, we're going to conclude upon the achieved level of control risk. Now, I'm going to talk about that in just a second because that's an important concept to understand. But what would be an example of this? Well, we identify risk in the cash receipts process. Okay, so cash receipts that there's a possibility that cash receipts could get stolen before they're recorded. That's an actual example that we're going to look at when we talk about revenues. We're going to talk about that in the cash receipts example. So what's a way of preventing cash receipts from getting stolen? There's a lot of different controls we can put in this way. I'm just going to say we're going to segregate duties. Okay. We're going to have whoever's responsible for custody is not the same person who's responsible for recording the cash receipt transaction, and that person can't authorize the deposit of the cash receipts transaction. So we as auditors are responsible for identifying that particular control, understanding it, and then if it's a reliance strategy, testing to make sure that control is effective. Now, you may have seen a flaw in my plan. You may say, Dr. Barnes, I'm thinking about this. And if somebody who's recording or somebody who's got segregation of duties has custody of the cash receipts function, couldn't they just put it in their pocket without telling anybody? I'd say, yes, that is a flaw in my control. Okay, so that would be something that you would identify as well. So the control does not appear to be designed properly. We're actually going to talk about what type of control we would use in that scenario. It's actually a little bit different from segregation of duties, but again, I wanted to use that since there's an easy identifiable scenario. So we conclude upon the achieved level of control risk. All right, so what is it, the type of work that we're going to do? Well, an example of this is that we're going to be actually performing types of test of controls, and these should look really familiar because we talked about the types of test of controls we can actually perform as our types of procedures we perform as test of controls: inspection records, documents, observation, inquiry, reperformance. There was a fifth one. What was that one called? Come on, guys, you had a test on this like 1 week ago, okay? 1 week ago. So fifth one, okay, it's not one of the ones that's listed. It's a combination of all the others. That's the way I described it. It begins the letter W. Walkthroughs, yes, walkthroughs. Okay, so what is a walkthrough? What is actually the technical definition of a walkthrough? So a walkthrough is following a transaction through a client's financial system from inception to inclusion in the financial statements, from beginning to end. So basically, we look at a single transaction. We see, how does this enter the system? What parts of the system does this transaction hit? And then eventually, how does it reach the financial statements? So we walk it through the entire transaction protocol. Now, there's a few interesting things about a walkthrough, okay? First of all, you will notice that I specifically said a transaction, which means that if we're testing controls, that we're dealing with transactions and events, which that's the category of assertions I said was only relevant to test of controls. Also, you notice I said a transaction. That sounds really, really weak. It's like, okay, we're testing one item, Dr. Barnes. That doesn't seem like it's sufficient. Well, again, we're not trying to test whether that individual transaction is correct. We're trying to determine, is the system processing the transaction correctly? We're not testing the transaction, we're testing the system, okay? And usually a walkthrough is a single transaction. Very high level reliability because it hits every single point in the system and gives us a lot of detail about how the internal control system works, because it looks at every single control that a transaction could possibly hit. Now, there may be a few caveats to that. You may say we have to test more than a single transactions because certain transactions may hit different parts of the system. That's true. Generally speaking, we try to have one transaction that hits all of the relevant controls that are going to be tested as part of our test of controls. So a single transaction is going to be sufficient, assuming that it hits all of those relevant controls. So we talked about our tests. We talked about what we're trying to do. Then we're going to come up with what we say is the achieved level of control risk. But how does that differentiate from assessed control risk? I talked about this on Monday, but let's go ahead and make sure we're clear on the distinction. So after the plan test of controls have been completed, the auditor should reach a conclusion on the achieved level of control risk. The auditor uses the achieved level of control risk to determine the level of detection risk that is needed to bring audit risk to an acceptably low level. So again, differentiate this from assessed control risk. During risk assessment, we determine, here's what we think control risk is for this client. We test controls, And then we say, this is what we believe after we've tested controls, the control risk is. You might say it's the actual level of control risk. You could use that term interchangeably. I hesitate to use that term because if the auditor makes a mistake, then the actual level of control risk is actually different than what they've determined. That being said, achieve level control risk is after test of controls have been completed. What is this important for? Well, remember, we're going to plug that into the audit risk model. We're going to say control risk is whatever, high, medium, or low. That makes detection risk high, medium, or low, which is going to make make risk and material statement high, medium, or low, which will determine our detection risk. And once we've determined detection risk, that actually determines the scope of our substantive procedures that we have remaining to perform. All right. So that in a nutshell is kind of the outline of how we would test controls. Now we're going to talk about specific tested controls when we get to the business process chapters. Again, you already have some insight because I've given you some examples, and we're going to talk about more examples over the course of the semester. But when we get to chapter 10, one of the most important things that we need to think about is, all right, what is our assertion or what is our risk? Start from there and move forward, because we have to identify what is going to be the control, what is the test to control, and do they all align with one another? So that's just a side of things to come. We do have more to talk about with respect to controls, but I want to move on to something that's relevant to audit testing. So something that's really important to note is that auditors do not generally perform all of their testing at one time, okay? If you've ever done an audit rotation, you probably heard them talk about things called interim procedures versus year-end procedures. Generally, when they talk about busy season, they say, well, we have a busy season from October to November or maybe mid-December, and then we're on Christmas break, and then we come back in mid-January, and then we have another busy season from January to mid-February. It's like, well, why don't they just consolidate one busy season, have it all year in? And there's a really good reason for that, okay? So we're going to talk a little bit about timing of audit procedures. And the idea behind timing of procedures is that audit procedures can be conducted at an interim date or at year end or period end if they don't have a calendar year end, okay, period end. Now, this is really done for a few reasons, but we're going to talk about the advantages and disadvantages. One of the big advantages to doing interim testing is that it allows the auditor to complete some testing prior to year end or period end. So if we identify that some tests can be performed before the financial statements are issued at the period end, let's get that work out of the way. Easy example of this, okay? We've got multiple tests over the course of the semester, so I have you all complete work over those tests, and then once that work is done, we kind of move on with testing in the future. So instead of having to do all of the work preparing for that exam at year end, you basically, or semester end, you basically do some work intermittently throughout the semester. So that's one perspective, but there is a disadvantage to that, okay? Typically, midterm or interim testing is less effective than period end testing. Interim testing is less effective than year end or period end testing. Now, let's think about why that's the case, why that might be the case. I want to talk about a very straightforward scenario, all right? I've got one exam in this course, and I'm trying to decide, do I want to put that exam in the middle of the semester, or do I put it at the end of the semester? What would be the problem with me putting that exam right in the middle of the semester? Yeah, well, not all the material's been covered, okay? So I actually test you at the middle of the semester. I said, okay, you guys have finished your exam. We still have a lot of auditing to talk about though. So please make sure you show up for class after that to be like, nope, out of here, Dr. Barnes, you know, okay? So there's not going to be enough, you're not going to have tested the full source of information. And so there's not going to be that knowledge gained that's going to be necessary for actually making that assessment. If I put it all at year end or at semester end, you guys would hate me because you'd be kind of like, this is miserable. One exam, who does that? Okay, honestly, not me. Okay, that would be miserable. I've actually taken courses where there was one exam and it was absolute misery. But would that be an adequate test of your knowledge relative to testing you at interim? Yeah, okay, it would be a much better test of knowledge because I've covered all the material by the time the semester ends. Okay, now again, there are trade-offs there. The semester end testing is going to be the most effective, but it also means that you all are going to have to study like for 40 hours at a time, okay, which nobody wants to do that. So that's why we do kind of the intermittent testing over the period. Same holds true for the auditors. Now, the reason that we're bringing up this up now is because oftentimes controls are tested at an interim period. Now, this is not true for every single control, but for a large number of controls, they're tested at an interim period. Now, we need to answer the question, why is that the case? Why is control testing at interim effective? And the answer is that we do not expect controls to change as frequently as everything else changes. So if control operates one way at June 1st, 2024, we expect it to operate the same way at December 31st, 2024. Now, we do have some responsibilities in that regard, and we're going to talk about that when we get to Chapter 7. We're actually going to look at a walkthrough control, and we're going to test at interim, and then we're going to do follow-up review at year end. The idea being is that even though we take for granted that the control is still going to be working a certain way at year end that it was at interim, we still have to make sure that that is the case. But for the most part, we do the rigorous testing at interim, and then we just basically do some follow-up work at year end to make sure that it's still consistently working. So what are the advantages of this? Well, auditor might test controls at this at interim date. Part of the reason we might do that is because the assertion testing tested may not be significant. The control has been effective in prior audits, or probably the most important one, it may be more efficient to conduct the test at that time, to test them at an interim period. Why is that the case? Given that the auditor is going to be extremely busy at year end, and most auditors have multiple engagements, saving all of their work for year end probably means that they're going to work a lot of hours. I mean, auditors already work a lot of hours even with interim testing. So imagine trying to just do no testing during an interim period and saving it all for the end. That would be literally no sleep, or actually literally no auditors, because nobody would do the job. Okay, so that's why we do that. So we want to get a lot of our work out of the way so we don't have to worry about it later. All right, so reason may be more efficient to conduct interim testing controls, less busy during interim. Testing controls at interim date give the auditor more time to reassess control risk and modify the audit plans if controls are found to be deficient. So this is kind of something we haven't talked about. Let's think about this though. We assess control risk, we test controls, and we find the controls are not as effective as we originally thought. Okay, so control risk is higher than we originally assessed. Does that affect our substantive procedures in any way? Yes, because if control risk is higher, detection risk is lower. If detection risk is lower, we have more work to do. So if we have more work to do, we're going to have to change our audit plan to say more work, which is going to be we're going to have to use be really diligent about the type of ink we use, because we're going to have to avoid the tiers that are falling on the audit program while we're doing that. Okay, but we put down more work, and we'd actually dictate what other types of work we'd have to perform. Additionally, interim testing enables management to correct any identified misstatements or remediate any control deficiencies prior to year end or period end. So this is an interesting one. Let's say we test a control and we found that the control itself is deficient, and we go talk to management and say, hey, this control that you have functioning is not working properly, and say, we will fix it, and we will fix it before the financial statements are issued. Is that going to make you feel good as an auditor? Should make you give you a little bit of warm feeling. It doesn't correct the fact that the control was not working properly up until that point, but if management can fix the control, it means that the control will be working correctly moving forward. We're going to talk a little bit about that. That's this idea of remediation, and we'll talk a lot more about it in Chapter 7. But usually when we see certain specific levels of control weaknesses, that creates a lot of problems for companies who are relying on controls. And we've got specific testing of controls that we have to perform as part of the internal controls over financial reporting. If a control fails, that can usually be problematic for organizations. So remediation is a good option for them to have available. All right. Got two wrap-up slides that I want to, oh, sorry, I guess I should probably talk about the cons. Yeah, the pros, the cons. Conducting testing at interim date may increase the risk of material misstatement and control deficiency are present. How can an auditor address this particular problem? Okay, so again, interim testing not as effective as year-end or period testing. So how do we address that problem? We can consider when it's appropriate to examine an account on an interim date. There are some accounts we may want to wait until period end. If we want to know that if there's some transactions that we think are only going to be relevant at period end, like especially closing transactions, we probably don't want to test those until after year end. We also can perform selected audit procedures for the period between the interim date and year end. Now, this is more general to audit testing as a whole and not just test of controls. But one thing that we can find is that we can actually perform some testing both at interim and at year end. And we can gain some assurance early and some assurance later. You're going to find an interesting practical example of this. This is for those of you who go into the work in the real world, that confirmations frequently are performed at two different times. Confirmations, remember those third-party requests that we talked about? Oftentimes they do some confirmations during the interim, and they do another batch of confirmations at year end. Is that so that we have double assurance that confirmations are correct? The answer is no. we get some assurance during interim, we have to do less work at year end. And that's the idea that's being held there. All right. So that in a nutshell is the idea of interim testing. Again, interim testing is generally going to be less effective than year end, but I'd say it's necessary to retain our sanity. That's kind of the goal that we're trying to get to there. Let's talk about service organizations. So when an organization provides accounting services to an entity, those services are considered part of the entity's financial reporting system. All right. Now, the way that this used to be described, or the way it's probably described in the book, and oftentimes still very, very frequently discussed, is outsourcing certain services that are provided by an outside organization. So has anybody ever heard of payroll outsourcing? Heard that concept before? There's actually a big payroll processing group called ADP. That's kind of the big example. There's a whole bunch more new ones, especially since the virtual environments have proliferated over the past couple of decades. The idea being is that an organization may say, we don't want to hire our own people to process payroll. We can actually have another company do that for us. What does that entail if you're an organization? If you have another company do payroll for you, it means that you're giving them information to in your system, that they are effectively part of your now part of your information system. So that creates a little bit of a quandary, because if they're now part of your information system, it means that anything that they're susceptible to risk to, you're also susceptible to that risk. So the logical conclusion is that if an auditor knows that service organizations are present, the auditor not only has to audit the client, but also all of the service organizations, right? Is that what we're going to do? So we're going to say not just audit our client, but every single service organization that they work with. That is a terrible idea, especially if you think about some of the large organizations that probably have thousands of service organizations that work with them, like Amazon or Walmart. If we as the auditors had to audit every single one of their service organizations, again, there's not enough time on the planet for that to list. We'd have to actually, again, go back to prehistoric times and start their audit then and do that. Okay, so that's not going to work. So auditor does have concerns that internal control system placed at the service organization, and so we're going to be making sure that those controls are correct. So to obtain an understanding of these internal controls, auditors should include a report on the service organization's controls. This is called a SOC report, a System and Organization Controls Report. And there are a few things to note about this that are very, very important with respect to auditors, okay? First of all, this is basically a communication from a service organization about their existing control structure. And this is a communication made by their auditors. So think about it. I'm the auditor for Amazon, okay? I've got ADP doing processing, which would be silly, by the way. ADP would not do processing for an organization like Amazon. But bear with me. Let's just assume that that's the case, okay? So if they're doing ADP, they're doing processing for payroll. As Amazon's auditor, I would talk to ADP's auditor and say, please give me a service or system and organization control report, because I need to have information about the controls that are in place at your organization so I can be satisfied that they won't hurt the controls in place at my organization. That's effectively what we talk about when we're discussing a SOC report, okay? Now, there's a lot more detail about this, and some of this is going to be extremely relevant. There are currently 5 types of SOC reports, but only one of these is specifically relevant to an audit, financial statement audit. That is actually going to be SOC 1. Okay, there's a reason I'm holding up my finger. It's SOC 1. All right. You may say, what are the other types too? It's like SOC 2, SOC 3. Then you say, oh, SOC 4, SOC 5. It says, no, SOC for cybersecurity and SOC for supply chain. But anyway, yeah, SOC 1 is the only one we're concerned about as an auditor. Okay, and SOC 1 relates to internal controls related to financial reporting. Okay, which we talked about why that's important. The other 2 SOC reports that are SOC 1, SOC 2, and SOC 3, they actually deal with controls related to operations and compliance, which is interesting because those are the other 2 components of COSO, if you remember. But SOC 1 is the one we as financial statement auditors are most concerned about. And there are 2 varieties of reports that we can be consider. So say, for example, I am the auditor of the company that I'm auditing, okay? And I need to reach out to a service organization and get a SOC report. Let's say the service organization does a minor amount of work for my company. So I just need to know if the design of controls is correct. That is where I would request a SOC 1 type 1 report. Okay. And by the way, when I say this, when I say SOC 1 is the numeral 1. They have Arabic numeral 1. Type 1 is the Roman numeral 1. Okay. So I say SOC 1, type 1. Think about it in your head, just like the visual letters. I'm not going to write on the board because my handwriting is terrible. Okay. But SOC Arabic numeral 1, okay, which is just traditional number 1, and then type 1 Roman numeral, the looks like a letter I, okay. That's the first type of report, and that is specifically over the design of controls in place at a service organization at a point in time. Hope you guys are going to watch this lecture because there's absolutely, I'm going to ask this on the exam, okay. So that type or type 1, sorry, the first type report is a SOC 1 type 1 report. So it basically represents controls that are in place that are the design of controls in place in an organization at a specific point in time. Okay. Now we already know that there are two ways the controls can fail. We know the controls can fail because they're not designed properly. What was the other way that a control can fail? So controls are not present or designed improperly, but the other one is the controls are designed properly, but they are not operating effectively. Is that what we're getting to? Yeah, we're getting there. Okay. So a SOC 1 type 2 report. Okay. So type II. Okay. Type 2 report looks at the design and operating effectiveness of internal controls. So design and operating effectiveness of internal controls in place at a service organization for a period of time. So SOC 1 type 1, design of controls only, looking at a point in time. SOC 1 type 2, design and operating effectiveness of controls in place at a service organization for a period of time. Important distinctions to make. The only reason that I make that distinction because that's a really critical one. This is one that financial statement auditors have to rely upon very heavily because they can't audit every single one of the service organizations for their client, which is not reasonable. Any questions on the difference between type 1 and type 2 for SOC 1 reports? Sure. Say type 1, design of controls only at a point in time. Type 2, design and operating effectiveness of controls for a period of time. Yes, Hudson.
And we're assuming that it's to do with financial reporting because they're giving accounting services related to financial reporting.
So basically anything that affects the control system that would be related to financial reporting would be a service organization that affects the internal controls in that area. So payroll would be a very obvious example because payroll is going to be something that's reported on the financial statements. Less relevant, but still probably one that we would consider like an internet service provider. Okay. Internet service provider would probably not be a SOC 1 report because it doesn't directly affect financial reporting, but it's still a service organization providing services to the company. So if they don't affect financial statement reporting, we probably would ask them for a different type of report, but that would not be the auditor. That would be somebody else. The auditor is only concerned about those service organizations that have a direct effect on financial reporting. Good question. Yeah, I spent a lot of time on that, but that's a really important concept to understand. Now, there's still 4 more reports out there, but we're not going to talk about those unless somebody wants to talk about those at the end project. So that's something to consider, okay? I left a lot of open ground for you guys to think about. All right. So final wrap up. Under the Sarbanes-Oxley Act of 2002, management public companies must prepare assessment of internal control effectiveness, and the registered auditors must issue opinion on the effectiveness of controls. We're going to talk about this in chapter 7. Why am I talking about it now? Because you may encounter this in your chapter 6 reading. Basically, when we start looking at controls specifically relevant to financial reporting, we are going to make an assessment. We're going to make an assessment of whether the control is effective or deficient. But there are varying levels of deficiencies that we can actually talk about. Now, the term control deficiency at a basic level talks about any time a control is not effective. But that's kind of our basic line. That's our baseline. That's where we say the control is deficient, okay? But it's not significant enough to result, or it's not significant or material enough to result in a significant misstatement, okay? So it's really small, basically. It's a really small issue. Then we have some things called significant deficiency and a material weakness. Now, I want to talk about a material weakness first because it's easier to conceptualize. A material weakness is a control deficiency that is so large in scope that it's likely to result in a material misstatement in the financial statements. Okay. Material weakness is what most organizations want to avoid. That's a very, very bad thing. All right. Remember, I was talking about remediation earlier. If we identified a material weakness in controls, that's where the client would want to step in and say, we've got to fix this problem now. So material weakness is large enough to result or to potentially result in a material misstatement. Does that mean that there is a material misstatement? No. It means that the controls are so bad that it's likely that a material misstatement exists. Okay. In the middle is something called a significant deficiency. Significant deficiency is very hard to conceptualize, but one of those things that's really important to understand. So significant deficiency basically says that it's not significant now, or sorry, it's not a problem now, but is likely to become a problem in the future. Now, I've got a really bad analogy, an embarrassing analogy that actually kind of explains this. All right. I used to have a big blue van that I drove around when I was in high school because my parents, when we were much, much younger, my brother and I, we took trips around the country during the summer. And my dad thought, well, having this big van for car to settle around would be great. And it was. So the van itself was about 10 years old. I did not take good care of it, which means that you had to change the oil consistently and add oil when it was running low. Of course, I was a stupid teenager and I carried that along into adulthood pretty heavily. But I was just kind of like, it was just like saying, I don't need to add oil. It's not a problem. And my friends would say, hey, you got that check engine light on. Says, yeah, that thing's always on. Just ignore it. Okay. Not a good idea, by the way. All right. So I did not have oil in my van. The van was running for a short period of time without any oil in there. So a car without oil in it is a significant deficiency. Is it a problem right now at the very current point in time? No. Is it likely to be a problem in the foreseeable future if not addressed? Absolutely. Anybody want to guess what happened to the van? It stopped working because it didn't have any oil in it. Okay. Yeah, it basically seized up because there was too much friction between the parts and basically said, yeah, when we're done here, this guy doesn't care about us. And this is embarrassing, but I admit it every single semester. That was my fault. Okay. My fault. My bad. Sorry about that, Paul. All right. So yeah, that's it. We're going to talk more about those concepts back in chapter 7, but we do have something to discuss. We're revisiting costs. All right. So I had you guys read through this scenario again and read a little bit more. So we've got some issues here. We know about some issues already from chapter 4, but we're talking specifically about controls here. So Sagdeva had a conspirator named Julie Mulvaney, and Julie Mulvaney helped her out. Now, I'm trying to figure out the nature of Julie Mulvaney, and I've been doing that for probably like 15 years now, trying to figure this out. Because this was a person who was either the most sympathetic individual on the planet or the most devious person on the planet, because there's only two ways that this can happen. One happens is that Sagdeva comes in and says, I screwed up again. Can you commit some more fraud for me? So like, oh, you didn't really mean it. That's okay. I'll fix the problem. Or was a willing accomplice like, okay, give me a cut of it and I'll go ahead and fix the problem. I'll make it go away. One of those two. I don't know which. Okay. I like to think that Julie Mulvaney is just like a really nice person and just basically committed fraud because she didn't want her friend to get into trouble. Okay. $34 million with the fraud, but still. Okay. Still. Anyway. Basically, there were some very, very basic thoughts about here. They were hiding they're creating false journal entries by overstating assets, expenses, and cost of sales, understating liability sales. Julie Mulvaney actually maintained binders of the actual false journal entries so that she can reconcile those. They included documentation of over 100 fraudulent transactions that were included in this company's accounting book records. Now, how could they hide this? Well, part of the reasons we know is good old Michael Koss, okay? Now, how do we describe Michael Koss back in the day? Hardworking, okay? Had 5 managed positions and then they basically did them all with exceptional ability, right? No, the guy was completely and totally lame, okay? By the way, if Koss sees this video, don't sue me, okay? I'm just reading from what the book tells us, okay? Anyway, and plus I think maybe I've got a legal court case. It's like, yeah, he really was pretty lame. He should not have been doing that. So Michael Koss basically delegated his responsibilities, did not review the work, okay? So internal control policy required Michael Koss to approve invoices of $5,000 or more for payment, but he delegated this to Sagdeva, and usually these cashier's checks still exceeded those thresholds. She did not get proper approval. So she was recording transactions for $100,000 that Michael Koss was not approving. So the controls did not prevent large wire transfers or cashier's checks outside of the accounts payable system for Sagdeva's purchase without seeking or approving Michael Koss's approval. So is that really important? Is it important to have an authorization function in your segregation of duties? Probably so. So one of two things are happening. Either authorization was not occurring, or if it was authorized, it was by the same person who was recording the transactions. okay, which kind of defeats the purpose. In addition, many account reconciliations are prepared to maintain or cost accounting records, and Cost's computerized accounting system was almost 30 years old. Now, keep in mind, this case is from the late 2000s, okay? So like 2009 was what kind of came to a head. Do the math back to 30 years old from 2009. We're talking about a late 70s, early 80s computer system, which, yeah, if you've ever seen one of those monstrosities, it's not one of those things you want to build a infrastructure on. Even back then, it was outdated. Okay, even back then, it's like, well, you know, anything over 15 years old, Dr. Barnes, that's ancient times. And I say, you hurt me when you say things like that, guys. You hurt me when you say things like that. All right. So I had you answer some questions for me. All right. So let's go ahead and let's talk about these. These are the questions I want, and I had some other questions that I specified that I wanted you to answer as well as part of the discussion. So major controls that were absent within Cost's internal control system. This is really low-hanging fruit. Okay. So I'm going to give it to you. Segregation of duties. Can we say that there were some problems with that in Cost's internal control system? Yes. Now, is this a design or operating effectiveness feature? Or is it possibly both? So we know it's operating effectiveness because we know Cost had responsibilities that he delegated to Mulvaney, which that's the operating effectiveness aspect. But can we say that there were probably design concerns as well? Yeah, Cost had 5 executive responsibility positions, which means that there was not separation of responsibilities in those areas. So both the design and operating effectiveness, that's the double whammy right there. That's kind of like, we don't even need to consider operating effectiveness, Mr. Cost, because you don't even have controls that are sufficient in this area. All right. What other ones can identify? So reconciliations, are those important? Remember 302, you do those bank reconciliations. What's the point of a reconciliation? To make sure you have the money that you say you have, okay? If you do your checking account reconciliation and say, okay, I believe that my books say that I've got $1 billion. My bank says I've got 33 cents. Is that a material difference? Yeah, it's usually so. So hopefully you do your reconciliations on your own, do those checkbook reconciliations, those banking reconciliations. What about their computerized accounting system? Can that be reviewed as a failure in controls? Probably so. It's hard to maintain adequate controls infrastructure because we know we have the 5 components of internal control, okay? We know the last one is monitoring. What is monitoring? Monitoring is updating controls in response to newer risks. How able do you think a control system is, an information technology system is with information technology controls? How able is that to address new risk if it's dealing with 30-year-old software and hardware? I mean, okay, think about it this way, okay? I want to update my system to address the threat of cyber attacks. My system was built in 1994, okay? How effective am I going to be in that? Do you know what we did for the internet in 1994? We basically plugged into a modem and called a internet service provider. And you probably heard that, you're like, that sound like that is not a good infrastructure for modern day technology, okay? That's what we're talking about here. We cannot address risks properly if our system is inappropriate. All right, so what are the controls can be implemented to assure proper controls over companies' recorded transactions? Well, the very first thing is make sure that Michael Koss is doing his job, but probably more importantly is that give other people Michael Koss's job, give multiple responsibility areas. That's one we've harped on, okay? Update the transactions or the information system to something that's a little bit more recent. Like if it's 2009, we'd like something like mid-90s at the minimum, okay? Yeah. Probably something more like closer to like 2009 technology, which is not that far off. Okay. So, and then controls, some very, very basic controls. All right. Making sure that we have oversight over certain transactions, making sure that we have separation of responsibilities. If there is something where there's a possibility of collusion, like we have in this scenario, making sure that somebody is reviewing the transactions in those areas and darn sure make sure there's approvals there. All right, so then the questions I had you answer. Based on the limited facts in the 2 take cases, assess Cost's internal controls using the COSO integrated framework. All right, so remember I told you you're going to be talking about more internal control integrated framework. There's 5 components. What's the top one? Control environment. What do you think about the control environment here? It's great, right? No, we don't think so, okay? Yeah, it's probably really, really hard to say that the tone of the top is good when the tone of the top is on the golf course, okay? So yeah, control environment, kind of problematic. Entities risk assessment. What's probably one of the biggest clues that they were not performing proper risk assessment, or some of the big clues from both of the cases? Like I think the outdating of like the board of directors and the computer systems, these were all like 30 years old, okay? Is it possible to do correct risk assessment if you don't have the mechanisms in place to do risk assessment? Probably not. Control activities is easy. We're saying, are the controls in place adequate? We already know they're not, okay? But the controls they had in place, they were communicating those effectively, right? So proper operating effectiveness of existing controls, right? Yeah, those are bad too, okay? We already know that Michael Koss was basically saying, I don't know what I'm doing. I'm going to have Sue do it, which would work in some scenarios, but not when the person you're delegating responsibilities for is the one committing the fraud, okay? And even if she was completely totally honest, it would not be a good idea. It would not be a good idea. And then we already talked about monitoring. It's really, really hard to update new risks when you're not updating the company things in the company, like the information system, or making sure that you have modern approaches. Particularly, one of the things that we talked about in the last time we talked about Cost Corporation is that there was a big changing environment right around the time that the fraud was revealed. That was when the global financial issue was going on. What is that? Global financial meltdown, the mortgage crisis, subprime mortgage crisis. And so auditors were going to be less present in their role because they were basically being paid fewer fees. That's a case, does that increase risk associated with the organization? Absolutely. If the auditors are not nearly going to be doing nearly as much work, it means that there's an opportunity for people within the organization to do things that they would normally not be able to do. All right. Recall from the discussion case 433 that Koss was not subject to required testing of internal controls or financial reporting. Despite the lacking of tested controls, Koss auditors are still required to obtain an understanding of internal controls. That's something we talked about. Understanding of controls, always required, okay? So the question here is not that the auditors test controls properly because they were not subject to testing controls over financial reporting specifically. They still probably tested controls in certain areas, but even if we say that they tested 0 controls, do we think based on the characteristics of this case that they were deficient in their understanding or their duty to obtain an understanding of Koss's controls? It's a really hard one to say because you say, well, we understood the controls. We understood the controls were not there. That would be the argument that the auditors probably say. It says, yeah, we understood the controls. It was very, very easy. It's like trying to understand a peanut butter and jelly sandwich. It's just basically just very, very simple and very straightforward, okay? I don't know why I use that as an analogy. It's the first thing that came to my head, okay? So, but honestly speaking, an auditor that does any reasonable due diligence in this regard, so they have identified that there were threats present, even without testing the controls, we probably should say that the controls themselves, they appeared to be weak and there were a lot of flaws. Just the fact that Michael Koss had 5 executive positions, you don't really need much more understanding of controls to look at that and say, yeah, that ain't right, okay? All right, my most interesting question, yes?
Last question, under SOX 4, are they required to like communicate their understanding anyway?
So it's going to be one of those things that's documented in the working papers about what they did with respect to controls, but they are not responsible for actually issuing a report or actually issuing an opinion. Because of basically the way that PCAOB requirements work is that unless they meet a certain threshold, which I believe at the time was $75 million in annual revenue, publicly traded companies were not subject to the requirements under the Sarbanes-Oxley Act. And I believe it's $100 billion nowadays, but basically that's how they got by it, is that we're a small company, internal controls are not as relevant to us. And that's the argument they made. So case notes that Saxdava colluded with Koss's senior accountant, Julie Mulvaney, to conceal her fraud. That's something we talked about at the beginning. Would a properly designed system of controls been effective in preventing this collusion? And before you answer, think very carefully, okay? Remember, it's Admiral Akbar from Star Wars. It's a trap, okay? It's a trap. So how many people think that a properly designed system of internal controls would have been effective in detecting this fraud? How many people think that it would not have been? How many people are too afraid to answer? A lot of people. Okay, all right, so yeah. The answer to this question is no, it would not have been effective. Why?
Because people.
Right. There are 3 limitations to internal controls, okay? Management override of controls, which probably occurred pretty frequently at Koss, mistakes and errors, and collusion, okay? Remember, that was the example of Hudson and Brett cheating that I talked about in the last class. No matter how good my controls are, I'm going to be subject to certain limitations with respect to the controls that I have in place. And the fact that they were colluding together means that the controls that they had in place, even if the controls were good, which they weren't, but even the controls were good, may not have prevented this fraud. Yes.
So it wouldn't be able to prevent the collusion, but could you say that it would probably minimize the risk of the fraud?
Absolutely. So whenever we think that there's a risk of collusion or a risk of limitation of internal controls, usually the response to that is to have kind of redundant or mitigating controls in another area. So one thing that we're going to see on the homework is we're going to see controls that both relate to the same assertion. Why would we create one control or two controls relating to an assertion when one control would do? And the answer is, if one control fails, another control can be effective in that area. Something to think about, by the way, as you're working on your homework. All right, with that, we've got homework that's due on Friday. I will see you all then.